All right, me again. Sorry about that. I still couldn't, I don't know why, but I still couldn't figure out how to allow questions. Last week it worked no problem, as did the week before. And I don't see a setting here within Live to allow or disallow questions for that matter. But I'm looking at my phone from the previous view, the previous Live, and I see your questions there, so I'm just going to read off there. Sorry, I don't know what happened. I'll try to get this figured out for next week. But so I'll read off the questions that you all posted before. Oh, so Cody just posted here. And I was able to see that. So it looks like you, yes, Elizabeth, I can see that. Okay, good. Very strange. I didn't do anything different now versus last time. So clearly you're all back. Yes, okay, good. All right, thank you. Sorry about that. I have no explanation for what happened. So yeah, so I'm done talking about what I wanted to talk about. Feel free to, sorry, but you can just repost your questions here. Renell Dennis, yes, just post questions or comments here. And I'm seeing them pop up. There is a 15 to 20 second delay, but I am seeing a bunch of you now are posting that you're back. You can see this, et cetera, et cetera. So for those of you that had questions, just dump them in here. Excellent, good. There we go. Question for Mark. What happens with an annuity that is from a traditional IRA that has a guaranteed lifetime withdrawal benefit and will dispense a set amount monthly? How is that factored into the other more standard investment balances for that year's RMD? Great. And Elizabeth says, welcome to the quote-unquote wonders of computer technology. Exactly, yeah. Which is funny because I consider myself somewhat tech-savvy and I have no explanation for the bungling it before. But back to Mark's question. So what happens if you have an annuity that has a guaranteed lifetime withdrawal benefit? Annuities get very complicated very fast, but to directly answer your question, when you have an annuity and it's providing you income, the annuity has not yet been annuitized. You haven't irrevocably handed it over to the insurance company in return for a stream of lifetime payments. What you're ultimately doing is you're just taking money out. You're just distributing money. It's under the terms of an annuity that says how much you can take out, but still, they're just simply distributions, as if you voluntarily said, give me $5,000 out of this annuity, the contract value of the annuity. These lifetime withdrawal benefit riders are no different. So if you own an annuity inside an IRA, and that annuity is throwing off some sort of income rider that you're taking out monthly or annually or whatever, you can simply take that amount of income and count it as a distribution. So let's put some numbers to it. Let's say you have an income rider that's throwing off 20 grand a year under your guaranteed lifetime withdrawal benefit. If your RMD across all your IRAs, again, you can aggregate the annuity in the IRA with your other IRAs if you have them. That $20,000 that you're getting from your income rider can be used to satisfy collectively whatever RMDs there are across your aggregated IRAs. If that withdrawal amount is more than your RMDs, then good for you. There's nothing you need to do. You're more than satisfying your RMD. If it's not, then whatever deficit there is, you will need to take out additional from one or multiple of your other IRAs to make sure your total distribution for the year is at least as much as what your RMD is. Again, that's just the IRAs. You cannot aggregate that with the 401k or 403b or other employer plan. Those are going to have their own separate cordoned off RMD requirements that you can't mix and mingle with your IRAs. Once that, here's where annuities get weird. Well, there's lots of things weird about them, but the way these riders work is every dollar you take out in these income benefits, income riders, it directly reduces your contract value or your balance by a dollar, an equivalent amount. Eventually, if you live long enough, your income benefit rider is going to completely deplete your contract value such that you now have a balance of zero. You'll still get paid your income benefit for life, most likely, assuming that that's the kind of rider you bought. At that point, that annuity is deemed to be annuitized. Even though you have zero contract value, there's still some inherent value in those expected payments you're going to get for the rest of your life. At that point, those the income payments that get thrown off still, that will only meet the RMD of that annuity. You can no longer use those income payments to offset RMDs across your other IRAs. That annuity is then deemed annuitized. Once an annuity is annuitized, its RMD only satisfies itself. It can't satisfy anything else outside of it. Fairly tricky stuff, but hopefully that answered your question, Mark. Next question, Laura. How do I calculate my numbers to plan on the best RMD this year? The RMD is what it is. You need to take, well, again, 2020 is an exception. All RMDs were waived thanks to the CARES Act for this year. So whatever your RMD would have been, you don't need to take it. But if you did, or yeah, let's assume you did, there is no best RMD. The RMD is what it is. Based on that table I showed before, you have to take out a certain amount any given year, and that amount is dictated by your age. You find your age, you use the factor. So it is what it is. You need to take out at least as much as the RMD, period. If you don't, you can be penalized. How much you choose to take out on top of that, that's up to a lot of things. I unfortunately can't answer that here. If you were a client and I knew your whole financial situation and we put together a plan, then yes, we can figure out the optimal number to take to meet your income needs, but still stay under certain tax thresholds and hurdles and stuff like that. So I can't say how much you should take, other than you need to take at least as much as the RMD each year. Tom, what are the requirements for a distribution of a Roth IRA after? Oh yes, good question. I forgot to come back to that. So what are the requirements for a distribution of a Roth IRA after inheritance? So when someone inherits a Roth account, there are RMDs in that they need to take out money, a certain amount of money each year, but it's not taxable because you already paid the tax as the original account owner. Now, there's always caveats to caveats. If you, the original account owner, did not have the account at least 5 years, and then you die and the person inherits it, they will need to pay tax on distributions. I forget the exact math behind it, but that's a scenario where they may have to. But assuming you own the account for at least 5 years before you die, whoever inherits it, they will need to take money out, but they will not need to pay any tax on it. Now, how much they need to take out, exactly, that's a good question. I'm drawing a blank. I don't know if this was changed in the CARES Act as well. It used to be, prior to the Secure Act, it was the same schedule as a regular IRA based on their remaining life expectancy. Again, normally wouldn't be taxed, but they at least had to take that much out. Now, post-Secure Act, I don't know. It's either still based on their life expectancy, or more likely it may need to be completely liquidated in 10 years. If that's the case, then again, it would also be non-taxable, but still they may need to take it all out in 10 years. Good question. I'll have to come back to that. I'm not 100% certain what the actual calculation is for inherited Roth IRAs, other than they're usually not taxable. David, what do you think of taking the RMD in December to allow the account to grow? Yeah, it's up to you. So if the RMD is based off of the prior December account balance, the assumption is if you think the market and whatever you're invested in is going to grow throughout the course of the year, then sure, leave the money in, let it keep growing, and then take it out. As long as you take it out before the end of the year, you meet the requirement, to not be penalized. That's sort of market timing, because what's to say the market won't go down during the course of the year? Who knows? I personally wouldn't try to time the ups and the downs of the market throughout the course of the year. Generally, over the long term, should go up, but in 1 year, who knows what can happen. So if you want to, great, but I wouldn't get too hung up on thinking your money's definitely going to grow. Now, if it's in something super safe and stable, like you have it all in like a money market fund where it will consistently churn out whatever, 1% or something, then yeah, then it's going to grow, albeit only a little bit. But if it's all invested in stocks, anything could happen in a year. I wouldn't necessarily bank on it definitively going up every year. Okay, Elizabeth, when withdrawing before 72 or more than RMD, is it better for heirs to convert to Roth or put it in a taxable portfolio? So I guess the question is not you as the account owner, but for your ultimate heirs and beneficiary, what's it better to do? It depends what your preference is. Do you want to minimize your taxes, or do you want to minimize your beneficiary's taxes? Or maybe it's a bit of both. There's a lot of angles to consider here, but let's say you're leaving it to an adult child who is in his or her peak earning years and very high income. Leaving tax-deferred money to them, they're probably going to pay a lot of tax on it. Granted, they have 10 years in which to take it out, but if they're in a really high-paying job and will be for the foreseeable future, they may ultimately lose a lot of money to taxes. So if you're in a lower tax bracket now than your beneficiaries are or will be, then maybe you want to take the tax hit now, convert it to a Roth, or just take it out, put it in a regular brokerage account or something, so that when you pass and the money goes on to your heirs, they inherit it either tax-free if it's a Roth, or if it's in a regular brokerage account, they get what's called step-up in basis. So they kind of inherit things at whatever price they're at the time. So any gain you had built up magically goes away for tax purposes upon them inheriting it. Not a precise answer, but there's no direct universal way to answer that question, Elizabeth. Okay, good. Renell, what happens when a spouse with the retirement account passes before the RMD age and his spouse is the beneficiary? Good question. So spouses have the most options out of any type of beneficiary. A spouse can simply take the account and put it in his or her own. So let's look at one extreme. Person who dies is 71, so the RMD age. Spouse is only 60, a decade away from RMDs. The spouse can take the entirety of the account and simply fold it into his or her own as a 60-year-old, and therefore not have to take any RMDs until the spouse then turns 72. So that's one option. The other option is the spouse can take it all out, the day the person dies or as soon as possible thereafter, or the spouse can still stretch it out if the spouse wanted to under his or her life expectancy. In most cases, the spouse usually just dumps it into their own account. There is some tax planning to be done. Again, if the spouse is really young, then maybe the spouse would elect to take the distributions at his or her life expectancy. Because if the spouse is super young, let's say 20 years old, there's a really large life expectancy. So by slowly trickling out some of the money every year that way, you may minimize the burden of otherwise just backloading all the money until the spouse turns 72 decades later and potentially builds up this monster nest egg, which could have a real big tax time bomb to it. So all depends. This is part of the joy of tax planning, is there's lots of unique situations to every person in life circumstance. So not a single answer I can give, but generally spouses would just put it into their own, and then it plays by that spouse's own rules as if it was always their own account. Pam, after you take your RMD from an IRA account, can you add it to a Roth account? Maybe. So first qualification is you can only ever contribute to a Roth if you have earned income. And you can only contribute as much as your earned income. So if you have a part-time job, you make $1,000 a year only, the most you can contribute to a Roth is only $1,000. It doesn't matter if you have $1 million sitting in cash in a savings account, you can only earn contribute up to what you actually earn. So yes, if you have a regular IRA, you can take your RMD, pay tax on it, you now have 10 grand cash sitting in your bank account from this RMD. If you're still working and earning wages or self-employed and earning self-employment income, yes, you can then turn around and contribute that to a Roth up to it's $7,000 this year if you're 50 or older, and assuming you have at least that much earned income. What you can do, it's not an RMD, but you can always convert as well. You can convert, transfer money over from an IRA by way of what's called conversion to a Roth, pay tax on it in the process. Once it's in the Roth, it then grows tax-free. Now, if you are of RMD age, so 72 or older, or if you were 70 and a half before this year, you still need to take your RMD. You can then convert after that, but you can't convert in lieu of taking an RMD. You're always going to need to take your RMD first, Then you can turn around and contribute that to a Roth if you're still working, again, up to $7,000. And then after that conversion, after that RMD, you can then convert more if you want on top of that, but you always need to take your RMD, Pam. Next question, is qualified and non-qualified annuities subject to RMD? Qualified, yes. Qualified simply means you bought the annuity within a tax-deferred vehicle like an IRA. They will be subject to RMDs. Non-qualified, no, it's not. Non-qualified simply means you bought the annuity outside of the tax-deferred world, so just with cash out of your checking account or something like that, or in a regular brokerage account. For those that are qualified, there's one exception, and I actually did a video about this a week or so ago called a QLAC, Qualified Longevity Annuity Contract. That is where you have money in an IRA or 401k or whatever. You buy an annuity, a specific type of annuity called a QLAC, Qualified Longevity Annuity Contract. That lets you delay starting payments on that annuity until age 85 at the latest. So let's say you take $100,000 within your IRA, you buy this QLAC, you choose to not start receiving payments under that QLAC until 85, you don't need to take any RMDs on that $100,000 in that QLAC until you eventually start payments. All your other money in your IRA that was not used to buy that QLAC, that balance will still be subject to RMDs. Got it? A little tricky. But to answer your question, yes, qualified annuities are, unless it's a QLAC. That's the one exception. Yep. Okay. Mark, follow up to the IRA annuity question. If the account value of the annuity is, for example, $200,000, and I will receive an annual payout of $30K, is the account value of the annuity added to the other IRAs to figure the sum of all my IRA account balances? Yes, it is. While that annuity still has some non-zero contract value, even if you're getting your income payments from your income rider, whatever reported contract value is for that annuity, yes, that's your balance that gets aggregated to all your other non-annuity IRA balances for purposes of your RMD. Jim, is the RMD always based on December 31st balance of previous year? I want to say yes, but the fact that you said that in caps makes me think, am I missing something? No, it's always December 31st, even if the year someone passes away. If they pass away before taking the RMD they're supposed to take, the RMD still needs to be taken out of that account, and it's still based off December 31st of the prior year. I was just thinking maybe is it date of death, but no, I'm pretty certain it's not. So it's always going to be December 31st. Maybe there's some obscure other scenario where it's not. If there is, it's not coming to me. So yes, assume practically it's always December 31st of previous year. Yes, Elizabeth, post-secure, still 10 years, and a penalty if not taken out in 10 years. Okay, thank you. Cody. Yep, so Cody has a comment, not a question. Comment. Beth, what is a backdoor Roth IRA? Good question. If you don't mind, please hold that and come back in 2 weeks. I think it's 2 weeks. You can see the schedule of topics, Facebook Live topics, right at the top of the group timeline. I think it's 2 weeks from today. I plan on discussing, I think it's actually how to do a backdoor Roth. Quick teaser, the point is, if you earn too much money to directly contribute to a Roth, you can make a non-deductible contribution to a regular IRA, then immediately convert it to a Roth IRA. Hence, you just got money into your Roth by way of the back door. I'll leave it at that. I don't want to give away too much. Again, come back. I think it's 2 weeks, and we'll be discussing all about backdoor Roth IRAs, but great question. And finally, Angie, can you explain the difference between a traditional IRA and a Roth IRA? Sorry, I'm very new to all this. No worries, Angie. Great question. I'll probably do either a video or a Facebook Live on that, but super high level. Traditional IRA means the money you put in today, you do not pay taxes on. So let's say you make $100,000, you contribute $6,000 to your traditional IRA. Well, guess what? You get to shave $6,000 off your taxable income so that you're only taxed on $94,000. So that money went in tax-free. As it's in there and it grows over the years, you don't owe any tax along the way. When you eventually take the money out, it's fully taxable at the time, whatever tax bracket you're in at the time, and it may also trigger off other taxes that I've discussed through other posts and videos. So that's traditional. It's called tax deferred. Roth IRA is the opposite. You do pay tax on the money you put in. So again, assume you made $100,000, you put $7,000, $6,000 into your Roth IRA, you're still taxed on $100,000 of income that year, even though you put $6,000 into your Roth. But the benefit of the Roth is once it's in there, it grows tax-free, and when you eventually take it out, it comes out tax-free. Now, there's some qualifications, which next week, actually, Facebook Live, I'll be discussing all the Roth withdrawal rules and provisions. But assuming you meet those, the money comes out tax-free. So the benefit is you take the tax hit now for the upside of you want to pay tax on it again, whether it's 5 years from now or 50 years from now. So you can get a lot of growth, ultimately coming out tax-free down in retirement. That's the Roth. So the main difference is, do you pay tax on the way in or pay tax on the way out? Traditional versus Roth. Good question. And looks, one final question. So yeah, we got 1 minute. So Angie, I am a beneficiary of both a traditional and Roth IRA. Stepchild, my father passed away September 2019. Does this mean I need to cash out both accounts within 10 years? No. So sorry to hear that, first of all. Because your father passed prior to the end of 2019, you fall under the pre-Secure Act RMD rules, which means you can stretch the withdrawals out over your life expectancy. You can Google this, you can ask the custodian that has these inherited accounts, or if you work with an advisor, ask him or her. But no, if you're, just make up a number, I don't see you, I don't know how old you are. If you're 40, let's say, I think you have 43 years, or the factor of 43 in which you need to take it out. So basically, there's a methodical way you need to dribble out some money every year for the next 43 years from both accounts. The traditional, you'll have to pay tax on as you take it out. It will, in the year you take it out, and it will be added to whatever other taxable income you have, wages, interest, pension, Social Security, I don't know. The Roth, most likely you don't have to pay tax on. You do have to still take withdrawals, but assuming your father, you got it from, had it at least 5 years and was over 59 and a half at his passing, you should not have to pay tax on your Roth. But definitely check with someone, because not only will your father, well, I don't know what age he was, but you would have needed to take an RMD last year. Now I'm second guessing myself. Was it last year or this year? If anyone hears me second guessing myself and knows the answer, let me know. But if someone inherited a traditional IRA and a Roth IRA in 2019, was their beneficiary RMD required last year, or is it delayed till this year? I'm not sure. Assume it was last year. I could be wrong. It might be this year. If it was this year, you're safe because all RMDs are waived for this year. But you may have needed to take an RMD last year, actually, from both of those, and pay tax on the traditional IRA you inherited. All right. So that's that. Great questions. Everyone, sorry for the snafu in the technology. I don't know what happened. There was not an option for me to flag on or flag off comments. I did nothing differently when I fired up the second live, so apologies for that. But thank you for bearing with me. Elizabeth, the first withdrawal is a year after their death. Yeah, right. I don't know why I forgot that, but that sounds right. So yeah, so Angie, so maybe you actually didn't need to take an RMD last year. You would have this year, but again, all RMDs were waived this year because of the CARES Act. So you might be in the clear for not taking anything last year or this year if you don't want to. Okay. Great. Well, thank you all. I will end it there. We are 2 minutes over. Hopefully you got a lot out of this. I will see you again same time next week, and have a safe and happy 4th of July. Thank you.